All right. Welcome everybody to Minus Investing Live. Happy Sunday afternoon. Hope everybody's had a good week. Busy week. I know I did. It's a pretty busy week for me. It's actually my birthday this week on Thursday. And also it's like basically the end of my school semester here in my college. So pretty much finishing up a lot of the finals and final essays and reports and stuff like that. Been a pretty busy week with the combination of those two. Honestly, I've been a little bit disengaged from a lot of my portfolio and market stuff like that. But either way, you can see right here on the screen year-to-date performance. So you can see over the last week, we diverged a little bit from the market, which is less than satisfactory, especially given some of the great performance of specific companies within that portfolio, specifically talking about Meta. Meta reported its earnings and had a really good report with a great reaction in the stock, which I definitely personally thought was pretty likely to occur. But as you can see, it doesn't seem to be really well reflected in my portfolio. But that comes partially just at the decline of a few of the other holdings. Oh, Jeff, what's up? On time. Really on time. Yeah, right there out the gate. Always good to have you. Good to have you right up front. But yeah, but regardless of being busy with school and kind of personal life, as I said, I did put out my Home Depot video this week. So anybody who is watching this live stream, live or on the replay, and hasn't watched the Home Depot video, please go check that out. I'm pretty proud of the video there, and it seems to be performing pretty well so far. So hopefully that one continues to do pretty well. I'm very interested in that company, by the way. Anybody who watches my video will see that I still find it to be a little bit overvalued, but we have optimism that perhaps it will come down to an even better value within the near future. Jeff won't be on long. Just wanted to say hi, see what I could. Yeah, of course. Always appreciate whenever you're here, and no obligation to be here. Nonetheless, I always have stuff to talk about, and presumably somebody else will show up here at some point. It's always like the first like little bit of the stream that seems to be the quietest part. It's usually like as it gets going that people start to show up typically, so that's just kind of normal. Anyway, I also brought up the poll which I put out this week, which was really just kind of a follow-up to our discussion surrounding Cathie Wood's price target for Tesla, which we covered in the live stream last week. I found that perhaps in 5 years Tesla could be worth, I can't remember the exact price it came up to, but it was definitely in this like middle category between $200 and $750 within 5 years. I found it to be possibly reasonably about fair value, I think around where it was currently at, given a lot of growth projections and a lot of optimism still. But you can see that the community seems to agree relatively or so, with most of the votes coming in between $0 and $200 or $200 and $750. I tried to kind of like set up the ranges of these spaces here in a way that would please both bears and bulls for Tesla. And you can see that there's one person who voted between $2,500 and $10,000 per share. But I will say that was actually me that made that vote on my other account, just because I was kind of having fun with it. Jeff, I watched the HD video. It was good. I've got this confusion with the model. When you calculate CAGR, are you anticipating that rate of return today when modeled, or when it hits IV? You mean FV? I assume you mean. I'm not. Let me pull up in the model because I think I know what you're talking about. But let me pull something up and I'll clarify. Oh, intrinsic value. Okay, fair. IV, FV, about the same. I guess it means basically the same in this context. Hold on. Pull this open. I assume you're talking about this. This is. Are you talking about whether what these expected returns, these CAGRs, and how they relate to these prices? Yeah. Okay. Yeah. See, that's what I kind of assumed you meant, because I've kind of gotten this question a little bit more than once already. So it's clearly a little bit confusing, the layout of it in some people's minds. What this is. Okay. So there's the two distributions here for the fair value and the expected returns, but it has to be understood that these are not like directly related to each other. It's not to say that like the exact same spot on here necessarily correlates to the exact same spot on here, but for every single one of the outcomes that's in here, there is an equivalent model somewhere in here, but which particular expected return is associated with which fair value kind of depends on which discount rate gets associated with each individual of those outcomes, because I have a range of probabilities for the discount rates as well. So the way that plays out with these fair values right here is that this is basically saying that there's the first quartile and the third quartile. So it's basically saying that in the first quartile, it's at the point where there's 25% of outcomes below it and 75% of outcomes above it. So it's saying that in a case where it's basically the 25th it's basically the 3 out of 4th worst outcome of all the potential outcomes that I've ranged here, I could say that it's potentially worth 231 today, and that at 231 we would still be expecting about a 6 to 7% expected return. So that means it would be less than 6 to 7% relative to today, even if it's worth 231, because it still has to go down to this fair value in the first place. So like this particular outcome, the $231 per share, it might actually be more like one of these like 3 or 4% or something like that based off of today. So I do understand, like, yeah, that's probably, it is a little bit confusing sometimes the way people see it. That's true for these three, but this particular one right here, where it says the expected returns at the expected level, this line talks about it as of if you were to purchase it today. So it's saying that at $267 per share, you buying it today, it's 11% overvalued, and we're expecting about 8.5% expected return. And then that logic holds through to this page, where I basically have the same thing output here. However, it is usually slightly different. You'll notice that the fair value is like a couple dollars off between this, and the reason why is because I've adjusted this particular value for the couple months worth of time value that's occurred since the projections come in. I do that so that when all the values end up on my dashboard, they're all aligned to the same date with each other. But that's just a minor adjustment. So, but when you look at it like on this page right here, it's basically saying that if you buy it today, you would get an 8.5% expected return, assuming all of my assumptions are accurate and assuming it goes to fair value over a 10-year period. Yeah, so it's like in a certain way, when you look at these two distributions, they should sort of be thought of as independent of each other, but they're still surrounding the same asset. So it's like these are the two things that would occur simultaneously, but it's not necessarily that each individual line is exactly aligned with each other. Okay, so today it's $295. If you bought today, you get an 8.5% expected CAGR for 10 years. Then if you bought it at $270, you do have a distribution curve for that. No, I don't really have a distribution curve for that, because this distribution is all of the potential fair values today. It's basically saying, given the range of outcomes that I've put into the model, this is all the ways that it could be fair value today, given the range of my uncertainty. That's what the distribution is supposed to say. So it's basically saying, like, I'm saying it could be worth anywhere from $150 to $435, but on an expected basis, I think it's worth about 267, which happens to be somewhere near the middle of the distribution. So all of these answers are fair values. That's the thing. All of these are intrinsic value today numbers. But the question is what probability do you assign to each individual one of those? And so it comes out that like the weighted probability is what the expected outcome is. The quartiles basically says, if maybe I'm significantly wrong to the downside, this could be fair value. If I'm significantly wrong to the upside, this could be fair value. And this is the fair value that happens to be in the middle of the pack. This is not quite middle of the pack, but middle of the pack that also weighs in the outliers, which is kind of what an average does. So it's like all of these could be fair value. The point is how much do you trust the assumptions that I put into the model? That's really kind of the point of having the third quartile, the median, and the first quartile. So like I like to buy companies when they're near the first quartile. And so what that tells me is that basically saying all the assumptions I put into the model, well, there's still a significant chance that I'm wrong on some of those assumptions. So I've given myself basically like a 3-to-1 odds against my own assumptions that maybe I'm still right. Yeah, it's a little bit confusing, because just like the way I'm using statistics is not necessarily like a common way to build your model. So it's like it's, and like I said, the layout isn't super clear. I do want to make some changes to this to try to make it a little bit clearer to look at, because this is definitely not the first time I've gotten this question, or a similar type question to it. So it's something that definitely needs to be worked on a little bit. My model looks almost identical to Cameron Stewart, Rational Investor channel. It's more based on applying a conservative growth rate and seeing the IRR if you bought today. Yeah, that's definitely another way to do it. Like, for example, that was basically the way that Kathy Wood's model was set up. Like they had an IRR that basically said, okay, well, based off of that, what do we think the returns are if it was fair value today? So it's like that's a common way to do the calculation. Yeah, because I'm not using an IRR. I'm using the discount rate that they have over the 10-year period that I've assigned to them, and then basically I'm taking the fair value, changing it up to find out what the fair value would be 10 years from now, and then I'm assuming that it goes to fair value over a 10-year period, and that's how I get to this 10-year expected CAGR. It's a little bit different than an IRR, but it gets you a pretty close number because they're relatively similar. You know, it's like it might be like 1 or 2 percentage points off depending on the company in question, but it typically gets you a somewhat similar number. But it does change things because of the way the terminal value is calculated, though. Then there is a distribution curve that shows 5% drop in share price of what the IRR would be. Okay, gotcha. Yeah, I mean, you can definitely build things like that, like a sensitivity table to the value. See, like I kind of am fine with just like this because I consider this a multi-layered sensitivity table because it basically already builds in all of the uncertainty of the other parts that I've built in. Like, as I said, like I use a set of probabilities for my terminal growth rate, a set of probabilities for my discount rate, a set of probabilities for my capital efficiency, a set of probabilities for my operating margin, and a set of probabilities for my projected period growth rates. So it's like all between all of those, that gets you a whole lot of different pieces of probability. And once you've calculated it all through and get this distribution, it's basically like a pretty complex sensitivity table built in, but it's not necessarily telling you what specific part of it is giving you the decrease in value. But it does give you the nice distribution shape, which I like because then it tells you kind of like where most of the value is bunched up. So which is kind of like the point of the quartile. So it's basically saying like in the third and first quartile, that third and first quartile is 75th and 25th percentiles, which means 50% is the difference between it. So when I look at this, I can say, okay, so between about $300 and $230 per share, about 50% of the outcomes are going to be between there. So if for some reason Home Depot tomorrow dropped to $230 per share, you might be like, oh, well, is this good enough returns? And it's like, well, it's about 3-to-1 odds that you're buying it undervalued, you know, according to the assumptions I put in here. That caveat, according to the assumptions I put in there, is kind of important. But yeah, so it's like there's different ways to kind of achieve somewhat of a similar effect. So anyway, let's go. Let's see, what was the next thing I was going to do? I was talking about the Kathy Wood post. Also, if you guys are watching live or on the replay, it'd be really appreciated if you would give us a like. Like us, help us with the YouTube algorithm. It's the #1 way to help us get noticed. Also, subscribe to the channel if you're not already. Whether you watch live or on replay, you want to make sure you have the notification bell clicked so that you get those notifications whenever I go live or whenever I put out videos like the Home Depot one. Also, consider joining the Discord. The link is in the description below. Also, the pinned comment in the chat. Join the Discord to be part of the daily discussions of what we've got going on in the market, in our own portfolios, and stuff like that. So come be part of the discussion there. Jeff, gotta run, gotta spend time with the fam. All right, catch you next week. See you next time. So let's see. One of the next things I was going to talk about today is kind of some of the action in the portfolio this week. Let's see here. Okay, so here's the portfolio pie. Or actually, before I get into like the specific action of the portfolio pie, I'll talk about some of the other things I was working on this week other than the Home Depot video. I did actually, I showed a little bit of this last week, this new portfolio sheet that I'm kind of working on. It's still very bare bones, but I'm kind of working on it in the background because I got like a lot of kind of background maintenance pieces that have to be put in place for this portfolio sheet to operate in quite the same level as the previous one that I've been using for a long time. As I was kind of explaining last week, the idea is to basically have all of my transaction data be coming in, and to be able to keep track of all the returns of my positions down to like an annualized return basis, which is something important to me. I was showing this last week, but unfortunately I had some calculations wrong in here, so it was kind of rearranging the weighted years wrong, so the annualized numbers were wrong. I did fix that problem. However, I still haven't managed to upgrade any of the other like display features for here, and haven't put any of the graphs in. But I've also been trying to put in my option pricing charts for that as well, because that's something that is also on that the previous portfolio spreadsheet, which is something that I never really showed before, my option pricing models. But so I'm trying to put together a little bit of a cleaner way for people to see basically the way in which I calculate the value of the option contracts as they are today, and then given a certain set of circumstances within the movement of SPY, which is the underlying asset itself, we can see that at a certain point later on down the contract, it can theoretically be worth a certain amount of money, and then that is how I can build the strategy out. I'll be trying to describe that a little bit more maybe in a week or two after I put more work into putting this sheet together. Other parts of it is tools that I had shown on the portfolio sheet before was a new framework I was using for allocating the weights in my portfolio. Previously, I had used a value score, which was a number that I had come up with, which basically took together expected returns as well as a general level of overvaluedness, as well as comparing it to relative other opportunities within my portfolio. And I used this like numeric tool, this value score tool, as a way to allocate the specific percentage for each position in my portfolio, basically based off of the opportunity it had within it. This was a tool I was using a lot last year, in the year before, and then at the end of last year, I kind of decided I didn't want to use that anymore, and I stopped using it. And I came up with a slightly different method, which was basically to say I built kind of a table of characteristics that stocks and companies may or may not have, that makes them what I consider slightly more risk, or at least more complicated to own for one reason or another. Maybe it's a highly illiquid company, maybe it's a foreign stock in a jurisdiction you're not as big of a fan of, maybe it has some sort of qualitative factor that's just not built into the value very well. But either way, the point is things that aren't being accounted for very well within the valuation I do, and using a table of all these elements to determine the new allocation of it. And that's basically what you're seeing right here, is this kind of table that I've put together, where I can basically just check off all the boxes for specific companies in different ways, and then that works together with a formula to assign a specific allocation size for each of my positions. So I've been working on that over the last week, while also trying to put together the option pricing model, which are, like I said, core elements that have to come together with also the transaction data that I was already talking about. All of these elements together, once they're all in place, I can eventually actually put together an accurate picture of my portfolio pie, like you see here, because this is on the previous sheet, as I was talking about before. So it's like 5 to 6 different like features that all have to be working independently for me to then put them together into one like larger core spreadsheet, which, like I said, I'm hoping to be able to show at some point within the next week or two. As I said, my school semester is ending here this week, which is going to free up a lot of time for me over the summer to be working on all sorts of random spreadsheet projects or investing projects and stuff like that. So yeah, very excited to be working on that stuff, but still very much a work in progress. So we'll come over here to the watch list with the model portfolios. Here we are with the model portfolios. You can see the year-to-date returns for the model portfolios are currently anywhere from about flat for the long-short portfolio, which is kind of somewhat to be expected for a long-short, to being up 8 to 9% for the undervalued and CAGR weighted portfolios, against it being up about 9 to 10% for the equal weight sample, which is our kind of guidance check against our random selection bias within this company of samples. Also comparing that to the S&P 500 total return, which is up about 9.2%. So our average return against the index is now negative for the year for the model portfolios, which the model portfolios, if you're new to the channel, is basically a summary of all the companies that we valued last year, weighted by the level of how undervalued we found them or what type of expected returns we found them, and then comparing that against, like I said, a randomly assigned equal weight for each of these companies, as well as checking it against the S&P 500 to see how good our research effectively is or was last year compared to the index this year. So against the index, we're now in negative territory. We were in positive territory for most of the year so far, so maybe it'll reverse a little bit in the next week or so. But as I kind of said, my returns were a bit lackluster this week. Apparently, so was the model portfolios, and also the average net of bias is negative territory as well. So both our absolute and relative advantage has disappeared in the model portfolios. Hopefully, like I said, that will start to reverse within the next week or so. But maybe it's just because the market was getting a little bit exuberant. Maybe turning on a little bit of a risk mode, a little bit more of a higher beta mode. What with the good tech earnings that came out this week. Hard to say the exact reason, but either way, we'll see how that performs moving forward. So coming back over to the portfolio pie here, I will talk about kind of some of the actions that happened within the portfolio a little bit this week, as I kind of already talked about and most people know about. Is Meta had really good earnings this week. They really blew off the top of the expectations, really kind of just eking out very small levels of growth in terms of revenue on the quarter and year over year from the previous quarter. However, they did manage to eke out still some subscriber gains and active user gains, or active user gains, monthly active user gains, and daily active user gains generally across the board. So the market was very, very pleased with that. Not to mention they had also made significant cost cutting, bringing their headcount back down to basically the level it was a year ago. And that still wasn't even counting some of the more recent layoffs that were announced in the news. So basically that leaves even more room for that headcount to be coming down within the next quarter or so. So we did get a good bounce up in Meta, and I actually did take a smaller amount of profits on that one. Took another trim. I know I've kind of been trimming small amounts of Meta on the regular as it's kind of continued to race up. Turns out, with it continuing to race up, it may have been better to just wait all that time, but is what it is. I was trying to make sure it didn't get over allocated. It wasn't that I thought it was some crazy overvalued company necessarily. I'm just trying to make sure my allocation sizes stay appropriate. But within, as I kind of had said as well, with Meta going up so much, that means for us to have not had as great of a week compared to the market, that means other companies must have been doing kind of poorly relative to the market. We were still up on the week. It's just not as good as the market. And looks like Google decided to crack out on me a little bit. Hopefully it comes right back. Give it a second. Google can be a little bit of a pain in the neck. We'll come over to the dashboard, look over here for a second. But anyway, so the point is that, yeah, we definitely had some major actions downward for a few of the companies this week. One in particular, Hibbett, which is one of our larger retail holdings. It's really didn't have necessarily a dramatic drop this week, but it's kind of been meandering downward a whole lot over the month of April in general. They themselves are expecting to report earnings in kind of the second half of May. So we'll have to see whether or not there's some sort of knowledge going on there. Maybe everybody in the market seems to know that those inventories are piling up, and maybe the profitability is definitely going to start to slip. I've built that into my model nonetheless, and I've taken some profits on some of Hibbett, but either way, I've been maintaining my position, so we'll have to see how those earnings play out. But yeah, definitely meandering downward a lot in that particular one. Sandfire Resources had a pretty significant drop this week, so that was definitely a significant part of it. Interfor, our lumber play, was also another significant dropper this week relative to kind of the upward action that it had been seeing prior to that. So there was definitely some counteracting to Meta's upward movement, and then also those companies in particular are pretty significant holdings for us, so that means that that's going to have a pretty outsized effect to that. Let's see here. One other company of note in the portfolio that had a pretty significant drop this week was also Activision Blizzard. What with the news coming out of the UK that their legal apparatus there is going to move to try to block the merger with or the acquisition by Microsoft. We'll have to see whether or not that's actually going to have any sort of material effect on it. But you can see it had a material effect on the stock this week, coming down from this kind of like 85 level that we were at, now down to this kind of like 75 level. Where it's currently at. Though if we zoom out a little bit on the chart a little bit, we can see that basically puts us back relatively close to where we were back for much of the start of the year. Obviously, Activision Blizzard had been kind of melting upward a little bit slowly over time throughout the end of last year and the early part of this year. And then we had gotten some relatively positive news from Microsoft with them saying that they were basically going to fight to make the merger happen, regardless of the opposition that they were receiving. So really, this is just kind of a tone switch back. It seems like to me. It seems like the market was very, very optimistic to begin with, and then they just got a little too optimistic, or maybe rightfully so optimistic. But then now they're just getting a little bit distracted from that. So who knows? This attitude could reverse on the Activision Blizzard thing. I've heard lots of people kind of make the point of, well, does the UK really necessarily have that much power when it comes to this type of thing? And I would say it's like when it comes to this particular industry, when it comes to like media entertainment industry, they have more power than like some industries. It's worth noting the UK is still a relatively small economy, but that doesn't necessarily mean that they don't have no power. And not to mention legal regimes tend to work hand in hand to a certain extent. So if the UK is putting up a big argument to it, it really kind of bolsters the US's own ability to make their own legal argument against it. That doesn't necessarily mean it's going to play out anyway. I haven't made any changes to my Activision holding. I'm still holding. I was actually commenting to some viewers on the channel behind the scenes a little bit when it was in this kind of high level up here. Once it made that pop up, I was actually considering taking profits. I was like, maybe I should just call it there a successful move and get out. Not because I didn't think the deal wasn't going to happen. I still do think that the deal is going to happen, but because I was just looking at it as a risk reward opportunity sort of thing, and was kind of commenting on it too because there was other YouTubers who were making videos about potentially starting positions at that point too, though they didn't end up doing so. But the point is I was considering taking profits, but now here I am kind of banging myself up for not having done so a little bit. But either way, we're still going to hold it through. We're going to hopefully get that 95 all the way through to the end, or maybe if it gets trimmed, I don't know. We'll see about that. So let's see what else the next. Oh, hey, cool. Google decided to pop back up a little bit and be working a little bit. Not that I had too much more to say on here. You can see cash levels now down below 19%. I think that's about where we were last week. So I don't think that's necessarily changed too much, but position still pretty solid here. As far as what I'm trying to think about for this week, what I'm looking at purchasing more of or not of, still probably gonna be buying more FG. That's pretty much just been like the go-to, as well as probably a little bit more MPW. I've still been kind of trying to build up a little bit of a position on that and feeling relatively confident about their ability to at least win back their honor in the markets with their court case, if not getting requisite pay for it. Man, Google really just does not want to cooperate with me today on my browser is what it is. Other things I'm going to be doing this summer once my school semester gets out is going to be revamping my whole technological setup. I need to be doing some research into some computer parts, looking to probably be doing a new computer build this summer, upgrade my computer. My computer is a bit old at this point. It was pretty high quality and state of the art when I built it, but I built it like 7, maybe almost 8 years ago at this point. So my computer is a bit old, a bit sluggish, even though it's still pretty capable of running quite a lot. But yeah, so definitely looking to do some upgrading on that. But I'm also looking to upgrade a whole lot of software that I use as related to streaming and video editing and stuff like that. So I'm kind of looking to do the big technological upgrade this summer too. This summer is really just going to be a whole lot of work for me, a whole lot of transformation behind the scenes. So anyway, moving on to kind of the topic that I actually put in the thumbnail on the kind of the title of the stream. We're going to talk a little bit about economic stuff, GDP, inflation, and Jerome Powell. This week here on the, I believe it's the first leading into the second, is the FOMC meeting with the next likely rate hike, as it's currently expected to be. We did get also GDP numbers in the second half of last week, which we eked out at least a positive GDP growth number for the quarter. But it's definitely coming down into kind of lower meandering levels of GDP growth in real GDP. Now I have up here on this chart, over at the Federal Reserve website, the gross domestic product and real gross domestic product. I believe on the quarter, the normal gross domestic product was like 1.5%, but if you take that and add the previous quarters as well to get up to about 7%. So nominal GDP over the last 12 months, including the first quarter of 2023, grew at about 7%. However, that includes inflation. So if you strip out inflation to get to real GDP, it means that the actual growth that we've experienced netted of just price differences ends up being about 1.5, 1.6% over the last 12 months. Again, that's the trailing 12 months, not just the most recent quarter. But the point is you can kind of see how that plays into it. So we managed to have pretty solid real growth even during the higher inflationary period. The difference between the blue and the red line effectively is the effective inflation. You can kind of see like what the effective inflation more typically had been for the years prior to the pandemic. Okay, so you can kind of see like how dramatic the effective inflation actually has been over the last few years. That you can see that right there, and then that's really squeezing out the real growth. So once the red line goes down into below the black line, that's a recession. That's what we define as a recession. Specifically, once it's been in there for at least 2 quarters, that's the 2-quarter rule. But obviously, there's funniness with the 2-quarter rule. It actually requires a few other factors and things like that because it's pronounced by another agency. But anyway, so if we then take the gross domestic product, specifically real gross domestic product, we're going to ignore the nominal levels and focus just on real values, and then split it into several subcategories. We're going to kind of like think about like different sections of the economy. Specifically, I'm breaking it into 4 main categories: federal government, state and local government, business, and households. Now, this technically doesn't include everything because there's another category of nonprofits. It's like households and nonprofits are often grouped together, but nonprofits basically, for the most part, is like wealthy people's money. For the most part, it's like households plus like how wealthy people taking their money, turning it into nonprofits and stuff like that. Not exactly. There's plenty of nonprofits that it doesn't apply to, but that's how I'm kind of just thinking of them as a group. So the point is, I wanted to focus more on like pure households and business, and then the 2 factors of government. Those are the sections I kind of wanted to focus on. So real GDP, focusing on that. I know these lines are like super close together, so we can't really see them very well, but just focus on the numbers there. So we can see the real growth in those 4 categories over the last 4 trailing months. And you can see that the strongest out of the 4 is actually households, which is pretty interesting to see. Household real growth is still solidly over 2%, netted of inflation. So households are still actually maintaining their strength pretty strongly. And then this is the part that's going to be kind of hard to see as well because, like I said, the lines are super close together. But if you kind of like focus in on a little bit of it, you can see that they were also the one that went down the least during the kind of 2020 timeframe. And if you kind of zoom out a little bit more, in general, they are kind of the least volatile of these sections, the households. Households tend to be a little bit less volatile, at least during this last decade. If you go back to the previous decades, you can see that they actually had a little bit more volatility back in 2008, but that was a little bit more of a one-off strange aspect there. Was peaking DLO. Hey, what's up, man? Pull that up. DLO. D local limited. Interesting. I'll pull up and we'll look at that maybe in a minute here once I finish the economic rant a little bit here. But anyway, so the point is focusing in on the growth of that, though. You can see that state and locals are also the next strongest. State and local is also pretty strong. Now, this is something I've seen a lot of people talk about, is just how flush with cash a lot of the state and local governments are after dealing with the pandemic, because of the way a lot of the federal expenses were handled. That actually basically set up a scenario where a lot of the state and local governments actually have far more cash and a lot less debt relative to where they've been moving into previous other economic cycles. And this is interesting because a lot of the local governments is the places where a lot of the more like public works types aspects of government financing goes. which is going to affect a lot of the the interim levels of economic growth. So the reason why I'm pointing that out is because like if you're going to think about like maintaining economic growth for a soft landing, if you're trying to think about like the ability for the economy to bounce back pretty strongly from the high interest rate levels, having a really robust state and local governments as well as households is actually pretty solidly positive, which I would say actually makes a lot of these GDP numbers look pretty good. The weaker portions of the GDP numbers coming in as business, which is at like 1.37, 1.38%, which isn't super weak. It's just kind of middling. It's not great, but it's not necessarily terrible. But then, funnily enough, the weakest of the categories is the federal government, which makes sense in a certain way when you think about it, because a lot of the programs from the pandemic era have been falling off. So the federal government has been spending less and less money. And when the federal government spends money, that counts towards GDP. So it kind of has this kind of counterintuitive effect where the government spends less money, and that's a good thing because we don't want the government to spend too much money, but that does cause a negative aspect towards GDP. So it's like a little counterintuitive, but the government rolling off the pandemic programs is possibly actually one of the things that's driving towards the weaker economic growth the most. What was that last follow-up you said? Never heard of, but I've seen some hedge funds adding. I only like USA, but looks interesting. Oh, that was a foreign one? I didn't even notice. Oh, Uruguay. It's a Uruguay company. That's pretty interesting. Yeah, I'm not super hype on a lot of South and Central America, not gonna lie. Some of them, I mean, like, there's a lot of potential in that part of the world, but there's also a lot of questionable legal regimes and stuff like that. So it's definitely a messy one. Yeah, and I know you're much less likely to invest there than I am, that's for sure. But anyway, so moving on from kind of like the cross categories there, I kind of just wanted to make that point of like how robust the household growth still is. And again, this is net of inflation. So if households are still growing 2.3% net of inflation, and that makes them the strongest, that basically means households are starting to actually pull in some of those wage gains relative to some of the other categories. That doesn't necessarily mean that they're not still feeling the pain, they're just feeling less, relatively speaking. So now if we focus in on inflation, which we also got some data for this week, we got the new core PCE numbers, which is the Fed's preferred gauge of inflation, which came in, I can't remember what the month-over-month number was. It was like 0.3% or something like that, 0.4% or whatever. But the annualized number ends up being about 4.59, 4.6%. Which you can see that's the red line is the core PCE right here. And you can see in general, the core PCE is not moving down too much. It's like we peaked core PCE at 5.42%, and now we're down to 4.6%. So core PCE has dropped 0.8% relative to 5.2%, which means it's dropped like 15% at most of its peak levels. Whereas like CPI, on the other hand, peaked at almost 9% and is already down to almost 5%, which is like 40% from its peak levels or something like that. So you can see it's really not moving too much. The other line I have here, the green one, is the CPI services less rent of shelter, which is kind of a third gauge that they've been talking about a lot lately, because services less shelter in a way is somewhat like a good gauge for specifically just like service based workers, part of the economy, by stripping out the housing portion of it. So it's a good gauge of the type of inflation that's affecting particularly low income and middling income wage workers, stuff like that, which incidentally enough, you can kind of get an idea of like when the green line is higher than the blue line or the red line for periods of time, that could theoretically be indicating solid wage growth above inflation to a certain extent. But then that it does have a little bit of a lagging effect because we're looking at the trailing levels here. That might make more sense if you look at specifically the month over month, which I actually do have on this chart right here. I did want to bring those up as well, so you can see like areas in which the green line is actually higher than the blue or the red for short periods of time. Like for example, here January 2022 through like June to July 2022, that was the period in which wage growth actually was going higher than inflation. And then like the latter half of 2022 was when you were seeing articles saying, oh, wage growth is starting to slip. And that really starts to make sense when you focus in on the specific subcategories of inflation like this. Clap the retail traders this week.
So much earnings and data news. Yeah, I don't know if you heard my comments a little bit about Hibbit a little bit earlier. I was talking about that. Hibbit's been slowly melting downward over the entire month, and it's like, well, market seems to be thinking that the earnings are not going to be too hot. Hibbit themselves doesn't have them report for some time, not till like the middle of May or something like that. What is it? May 25th through May 29th is the expected one for Hibbit, so it's a while for them. But yeah, we're definitely going to be getting some of those other retail traders coming in on other names this week, and we'll have to see how that affects some of the other companies. So focusing in though on the core PCE number here, this is all backwards looking information, so it's really difficult to try to get an estimate of like where inflation is going, because when we look at these trailing numbers year over year, a lot of people say, oh well, that's so backwards looking because it includes a lot of the previous months, which is true. For example, we added on the month of March here on the core PCE in this particular number right here, and the core PCE for this month was about 30 basis points. If you go back to the previous March in the previous year, that gives you an idea of basically when we're rolling off certain numbers. So whenever there's a high number on the month over month way back about 1 year ago in the chart, then that means whenever that next month comes in, it's going to roll off that higher number, giving a larger amount of room for it to jump downward. Basically, like as the comps roll through, it basically rolls downward, much the same way that high earnings on a company makes it look like they have a really low PE, but really you just have to account for the fact that the earnings are going to drop next year. So it's sort of like the same effect, but we're talking about inflation. So you can sort of see some areas where this exists right now. For example, the CPI services less shelter, the green line right here, has a very, very large jump up in June 2022, which means that when we get the number for June 2023, that's going to have probably a huge bump downward for those particular gauges. So let's see, June. So it's going to be a few months further out right here. So that gives a lot of wiggle room for both the blue line and the green line to be dropping down significantly below the red line within the next the month or two. But that doesn't necessarily mean that the red line is going to move down the same way, because if you look at where the red line is in that exact same month, it had about half as much of an increase. So that means that while some of these gauges are going to have that large drop down in like the June kind of time frame, that doesn't necessarily mean that all the gauges are. Who knows Fred? Yeah, I know. Fred's such a popular guy. Who is this Fred guy? Wouldn't it be interesting if you could invest in Fred? I mean, of course, that means they'd have to be like making profits. This is like a government website. Who owns Fred? This is a government website. This is the Federal Reserve website. This is the Federal Reserve Economic Data website. Federal Reserve Bank, St. Louis. Yeah. Yeah, this is government data, publicly access information. Yeah, it would be pretty neat if it was a publicly traded company. I don't know how they would sustain a business model, because that means that they'd probably have to like charge for the data or something like that. So it would change things. Well, it's technically .org, technically, and I think that's because the Federal Reserve, that whole private public distinction thing. So I think the Federal Reserve technically doesn't have the .gov because of that. Yeah, because hold on a second, because like there's the Federal Reserve.gov, but the St. Louis Fed is org, because that's right. Okay, so the Federal Reserve does have a .gov, but I think it's the individual Fed banks are all .orgs. So this is the St. Louis Fed, and so it's an org website as a result. Yeah, it's a little bit of a weird setup. Hey man, sidetrack all you want. You know, we don't got too many other people in here talking about stuff. I'll keep it on point one way or the other. So thinking about where the core PC is going to go over time, we can kind of think about the current month over month versus that trailing level. I was just saying the trailing level, a lot of people say, okay, well, you can't really think about the trailing level without knowing what the previous months look like. And so it's really more, you should think about the current month and think about like where things are headed. So in order to sort of do that, I took specifically just the red line, focusing it right here. The red line is now actually the blue line because it kind of switched colors a little bit. But I have the core PCE, but then the more jagged one is basically taking the specifically the month over month level of the core PCE and then annualizing it out to a level, an annual level. So we're basically saying is like, okay, well, what if we took the current month level and we assume that that's actually a decent gauge of what the next forward year is going to look like, and then multiply it up by 12 and then put it over the actual core PCE. And so what that would tell you is that if we were actually having core PCE starting to kind of trend downward, we would start to see multiple red points below the blue line in a row, because it would basically be starting to lead the trend downward. The red is kind of like the lower average, while the blue is kind of more like a moving average of the red. And so as the red moves downward, the blue would start to shift downward with it. But we don't really see that. We don't really see that to be much at all, to be honest. You know, it's like, okay, we had like 2, 3, we had 4 in a row of the red being below the blue here in the middle of 2022, but that was before summer in 2022. And then we went back above for a while, and then we held it line for a while. Now in the most recent couple months, we've had 2 below. Maybe if we could have another couple below for a while, it's hard to say, but then maybe we're going to move into summer where it starts to take off a little bit more again. The point is I don't see core PCE starting to move downward at all. It really just looks like it's kind of keeping trend. At best, it's moving down at a very, very slow rate, not at any sort of accelerated rate. So it's hard to say that we're really getting the job done. Now coming over to this table, which I've shown a couple times on stream before, where I've taken the treasury rates as they were at the end of 2021, which is basically when the rate hiking and quantitative tightening cycle started. I took all of the treasury rates from the federal funds rate up through 3 months, all the way up to the 30-year, and then I also included the 30-year mortgage, basically to get an idea of basically interest rates across the board, across the duration length panel, and then I compared them to the current for each of those rates, which I have right here. I filled this out yesterday, so it's accurate at least up to yesterday. And then I did the same thing for the CPI. I took the level that it was at the end of 2021, and then compared it with the trailing year-over-year level that it's currently at. And then I did the same thing also with core PC, the level it was at the end of 2021, and then the level it's at currently for each of these. And then what I have for these little sections in here is that I subtract that CPI level or that core PCE level from the federal funds level or from any of these interest levels to get an idea of what the real yield is across each of these durations at each of these time frames. And so we're comparing the real yields at the end of 2021 to the real yields as they are today, and then seeing what the overall net change between them is. And effectively speaking, for each amount of change in the interest rate, how much change have we actually gotten in the inflation gauge? For the CPI, for every 1% increase in the interest rates, we've gotten about 1.16% increase or decrease in the CPI. For core PCE, for every 1% increase in interest rates, we've gotten about a 0.81% decrease in core PCE. If you take an average between just those two gauges, that gets you 99%, which basically means we get about a 1-for-1 difference depending on which inflation gauge you're using. If you're using core PCE, it would say that it's actually lagging a little bit, and it's not actually going down as fast as you would hope with the real yields. Whereas with CPI, it actually does look like it's going with the program a little bit better. Like I said, average between the two, and nets out at basically being 1-for-1, no real difference. Now, the goal, according to the Federal Reserve, is to get core PCE down to 2%. That's the target that they're attempting to reach as of what they say. They could eventually say, hey, actually, you know what, we're going to settle for a higher inflation rate. That's always something they could theoretically do. But assuming they really are trying to do the job all the way till the end, when it gets to core PCE down to 2%, that's what they're trying to do. Now, today, as of the end of April, that means approximately they've had 11 sessions of QT, a session being defined as the period between rate cycles, which is about 2 months or so. Give or take. They meet about 8 times a year. It's a little bit of a weird kind of off cycle setup, but 8 times a year is how often they meet. We've been through about 11 meetings so far in this process, and in that process so far, the amount of work that they've achieved is the amount that we've said they've managed to basically move inch for inch, approximately 1% for 1%. which means, yes, they've managed to get the inflation gauge down a decent amount, but not necessarily amount as they would like. To get back down to 2%, they would need to get 2.6% down further, because we're currently at 4.6%. And so I said, okay, maybe they don't need to go all the way to 2.6%, because maybe it's going to start to go faster. So I said, okay, well, can we adjust it for a certain expected level of acceleration? And the level of acceleration I was willing to accept it by is the 1.16% of the CPI going faster. So I'm assuming even in the best case scenario, where the CPI is actually a good measure of how fast the process has been accelerating, that means maybe being generous, out of the 2.6% difference to core PCE, maybe they really only need to do about 1.4% of it, and then the market will effectively just do the rest of the work. At about a 25 basis point hike per meeting, that would mean that they would have to bring the Fed funds rate up to about 6.1%, which would mean approximately 6 more meetings. 6 more meetings counting this meeting that we're doing this week. So with that, I would argue that there's a pretty good chance that we're going to be doing rate hikes for the rest of the year. I don't, a lot of the tune in the market has constantly been, oh, 1 or 2 more rate hikes and then we're done. But I don't know if anybody's been paying attention, but that's been the story for like 3 or 4 rate hikes now, which means that 4 rate hikes ago, if someone had said, hey, there's going to be 6 more rate hikes, they would have been accurate, but everyone would have called them crazy. So I'm gonna go ahead and be that person here today who's now gonna say, hey, I think we might be getting like 5 to 6 more rate hikes. I think we might be rate hiking all the way through the November meeting. I think that's actually very, very possible that that's what's gonna happen. And that might be an unpopular opinion today, but we'll see how that prediction holds up for the rest of the year. So yeah, here we are at the CME website, where it gives us the Fed futures curve. You can see right here the current market expectations for where the Fed funds is going to go. The Fed meeting that's expected this week. Oh, I think I was saying the May 1st, May 2nd. It's actually, I think, May 2nd, May 3rd. But whatever. This week on May 3rd, it's expected about an 84% chance that we're going to have a 25% basis point hike. And then the market is projecting that we're going to be flat for the next 3 meetings thereafter. And then in the November meeting, we're going to go down 25 basis points. So I'm arguing that this is super wrong, and that we will actually be going up to 525, 550 in June, which it looks like only about 26 to 27% agree with me there. And then the chart doesn't even show the potential for how many people agree with me for the rest of the time period, because I would be arguing that the Fed funds rate is actually going to be more like here in November. And yet the curve seems to be believing that we're going to be dropping dramatically, not starting in November, but then through the rest of 2024. So who knows? Maybe that prediction will age like milk. We'll see. We'll see how badly it ages. I will say that I've technically have already made similar, softer versions of that prediction over the last several months. I've been saying for months, I think we're going to go higher. I think we're going to go higher. I think we're going to go higher. And I've been right pretty much every time so far in the process of that, even though that hasn't necessarily played out in the way that the market has reacted. So who knows? At some point or another, the market might actually be right about it. And my assumptions here assumes that the economy doesn't really break first. So that's one large caveat there, is that it assumes that the Fed is that their primary concern is bringing core PC down to 2%. They could always change their tune about that. As I've said, it's like they could change their mind and say 3% is actually acceptable, at which point it kind of cuts my expected level of hikes in half. They could also decide that 3% is acceptable, but they also would rather prioritize saving the financial system if we have to go through another crazy turbulent situation, which is always possible. And again, that's also keeping in mind that the interest rates would be going up during this time frame. So more quantitative tightening would be occurring, more pressure on the economic system as a whole. But then coming back around to, as I was saying, with the economic growth, those households are still being pretty resilient. The state and local governments are still flush with cash, which gives them a lot of wiggle room to then help both households and businesses if they need such help. So who knows? Maybe the economy really can actually withstand those rate hikes, and we really will go all the way to 6.1%. So yeah, that's my prediction as it currently stands. Terminal Fed funds rate 6.1%, possibly by the end of the year. At that point, then I really do think that we would probably have peaked. At that point, I don't think that, not only do I think that would be enough to get the job done, but at that point, we probably would be heading for some serious economic pain, which means they probably almost certainly would be cutting the rates at that point. But at that point, they might be able to cut rates without it being such a dramatic risk to long-term inflation. So at that point, they would actually have my support for dropping rates if they really did make it all the way up there and core PCE really was dropping rapidly towards that 2% level. But who knows? We'll see if that's really what plays out over the next year or so. Like I said, it's a pretty specific prediction that I gave here today. I'm pretty much specifically saying that we're going to be between 6 and 6.25% by year end. Like that's a pretty solid specific prediction. So we'll see. Maybe it'll age like fine wine or sour milk. Who knows? So let's see. That's pretty much everything that I had on my little economic rant. I saw somebody liked the stream there in the interim. I'll go ahead and ask for more. If you're watching live or on the replay, please like the stream. We really appreciate it. It's the best way you can help us grow and help us with the YouTube algorithm. Please also subscribe to the channel if you're not already. Subscribe, ring that notification bell. Make sure you get notifications whenever I go live or whenever I release other content. Join the Discord, the free Discord. The link is in the description below. It's the best way that you can be part of the group. We have daily discussions of what's going on in the markets, what we're thinking about for our own portfolios, the actions of other major investors and things like that. So come be part of the group there. As I said, that's pretty much all the kind of specific topics that I had on my mind to talk about here today. If people are still in the chat or not, we can throw out some tickers, maybe take a look at them. Or maybe we can bring the stream kind of to a little bit of a close. It's coming in a little bit under the hour, which is not too early to end it, in my opinion. Let's see. Like I know you threw the DLO one up there, which I mean, like I said, I'm definitely not super interested in Uruguay necessarily, but you can take a look at it briefly. See if maybe we can figure out what's so attractive to it for those hedge funds. Apparently DLocal Limited operates a payment processing platform worldwide. Man, it's always these like weird payment processors that exist in like strange little countries. It's like I guess payment processor is an easy business model to create anywhere and market it to the rest of the world, so I guess it sort of makes sense. But I kind of find it funny that like that specific sub industry is like the thing is being found in so many other places. Its payments platform enables merchants to get paid, to make payments online. The company serves commerce, streaming, ride-hailing, financial services, advertising, and software as a service, travel, e-learning, on-demand delivery, gaming, and crypto industries. Interesting. Yeah, I don't know about that domicile though. That definitely looks like a pain. Oh, so look at the growth rates though. That could definitely be the reason why the hedge funds are paying so much attention to it. If they're expecting 50% this year and then almost 40% next year, it very much could just be an easy miscalculation on that to possibly find a higher pricing, higher levels of momentum for it. Had no debt, great margins, PE was high. Yeah, I did see the PE, 38 PE, but I mean 38 PE, if they're going to grow 50% and then 40%, that could bring that down into the 20s pretty quickly. What's their profitability look like over time? See, like back in 2019, $55 million of revenue versus 15 million in net income. And then the margins, yeah, okay. So they do have high margins. That's kind of what I wanted to check. I was like, did they have those same margins back before the pandemic, or is this just like all new? Looks like they actually have pretty consistent profitability, which is interesting. At least before financing. I don't know. Yeah, I mean, for a rinky-dinky little thing in Uruguay, it definitely has pretty good-looking financials, assuming that they're good. That's definitely a lot of growth in front of it. Definitely not enthusiastic about that industry though. Payment processors. Like unless you're one of those big dogs like V or something, it's like, which, you know, we've talked about those. I think they're too expensive. Alpha CEF. Hi, what's up, bud? Welcome to the stream. I don't think I've seen your name before. Appreciate you joining us. You know, one I've kind of been curious to look at, a random small company, is Rumble. I've kind of been like curious to see about this. I pay attention to I mean, I watch a lot of YouTube content. First of all, it's like I'm a YouTuber, but I actually consume quite a lot of YouTube content. But like on a variety of different subjects, I pay attention to like a lot of political content and a lot of streamers, a lot of people have been talking about this company a lot. Apparently, it's like an up and coming streaming platform, which so far seems to be like catering to a lot of like weird, quirky corner of the internet types. So it may not ever really become anything, but at the same time, they've still been pulling some semi-big names. And like, for example, look at the growth rate that's expected this year is like 240%. So it's like, supposedly they have some pretty strong growing user numbers, but there's also been like some weird like questions about like whether or not their user numbers are actually like reflective of reality or not. So yeah. Oh yeah, the restream bot. Yeah, that took some time to figure out how to get that set up to get it to do that, but it's pretty worthwhile. But yeah, because let's see, I stream to YouTube, Twitch, Facebook, and Twitter all simultaneously. So if people comment in any of them, it's supposed to automatically send the comments to and fro. And then as I've showed you as well, we also have the it also sends it to the chat log in the Discord. Yeah, no, pretty cool. It's pretty worthwhile. It'd be nicer if we had more more viewers, so that it was like actually like had served more of a purpose. But hey, for the random buddy like Alpha CEF, at least he gets his comment seen, because it's going all the way through. Yeah, it's pretty cool. It's pretty neat little website. Restream is a pretty cool website in general for what they offer. But yeah, so I've definitely been kind of curious about this company. It could end up being like a total garbage nothing, but it also could, I don't know, end up being some maverick small streaming platform thing that starts to grow like a competitor to like a YouTube or a Twitch type thing. I've also heard some discussions about whether or not Amazon could spin off Twitch too. I've heard plenty of people discuss that topic as well. And then, of course, also, well, I mean, with it being a small little streamer thing, it could also be acquired by one of the other players as well. That's another thing. It's like maybe Alphabet or Amazon would just outright acquire them or something. I don't know. But anyway, so I think that's probably going to do it for today, though. Pretty chill, pretty quiet. Mostly just kind of wanted to rant a little bit about that economic stuff. It's been a pretty busy week, as I said. Hopefully we'll have a little bit more for you guys next week. Maybe we'll have a little bit of a busier crowd as well. But appreciate everyone that showed up today. Like and subscribe to the channel on your way out. As I said at the start of the stream, if you haven't watched the Home Depot video, check that out. Pretty proud of the video. I think it's pretty good, and I'm really hoping that company comes down more in price in the near future, because man, I would really like a position in it. But all right, I'll catch you all again next week. All right, bye.